In this presentation, we will enter an adjusting entry for accrued interest within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. You can open the open windows by going to the view drop-down and selecting the open windows list. What we will do now is enter an adjusting entry, the period in entries for accrued interest. So to do that, let's take a look at our financial statements. Going to go to reports up top. We're going to go down to company and financials. And we're going to first take a look at the balance sheet standard. The balance sheet standard, we're going to change the customized reports items here to change the date range, that date range being 01/01/19 to 02/28/19. So January 1st to February 28th, 2019 and okay. These are going to be the adjusting entries we're going to have here. And they're going to be entries that we typically would need some more kind of understanding of debits and credits to do and accrual accounting. And they might be things, if we do just bookkeeping, that we might want to separate from the accounting department or the bookkeeping department or our bookkeeping work from the adjusting that may be done by a separate department or by an outside CPA firm. It could be useful for us, in other words, to say, hey, we're doing the bookkeeping planning on these adjustments to be made and done by a CPA firm, and then working with a CPA firm or another accountant or an adjusting department to make those. Or we process these through ourselves at the end of the period. Either way, we typically will need some type of adjustments at the end to make sure our financial statements are correct on an accrual basis, for if we need to present them for, say, a loan or for tax preparation purposes. It could be something that we should be doing as well. So in this case, we're going to go to the interest expense. And we're thinking about interest expense on a loan. So for example, if we go down to this loan down here, we've got the loan payable. And we had done some adjustments breaking out the current portion versus the long-term portion of these loans. Now, when we thought of the two types of loans, we have an installment loan, which we pay monthly. And we have some other types of loans that we might have that we don't pay until the end of the loan period. So if we go to our examples of the loans in terms of our amortizations, we had two loans that are included in this loan payable, or were when we started. So we're going to say one was this installment loan. And in this one, it was a larger loan that we're going to pay back in periodic installment payments, breaking out interest and principal, and the loan is for 60 months or 5 years. The second one was this loan for $5,000, and it was a little bit different. We borrowed $5,000 and we said, we're not going to make installments. We're not going to pay it back monthly. We're just going to pay you back the loan balance plus the principal after the term of the loan, which is this, in this case, is 6 months. So the difference between those two, if we go back to the long-term loan, this is probably the one we're more familiar with, because we typically have to make these estimated payments or these monthly payments when we have normal type of loans. If we got a car loan or a mortgage loan, this is how it's usually formatted. And in this case, we need to break out the short-term and long-term portion, but we don't usually have to accrue the interest because it will be paid as we go each month. So this one, our major problem is breaking out that short-term and long-term portion. Going back to the short-term loan here that we have, this format is one in which we have a problem of valuing our loan too small on the financials, meaning we really owe more than $5,000 at this point in time. At the end of this loan, we're going to be paying $5,152 at the end of this loan. That's how much we're going to have to pay back. And we only have on the books $5,000 because that's what we borrowed. And so you might think, well, what it really should be is what we're going to pay back. We're going to pay back $5,152. We should make an adjustment for the difference, the 152, because that's what we actually owe. But in reality, we don't really owe that because it's only the interest, and the interest is kind of like a rent. So we're borrowing $5,000, we owe interest on it periodically, and if we were to record all of it at this point in time, that would be like us recording the rent on the building we are using today for next year's rent. We may have signed the lease, we may owe it, but we don't owe it today, even though we're kind of contractually required to pay it because they haven't given us the use of the building. If they kicked us out of the building, we wouldn't owe the rent on it. And the same thing is true here. Even though we're going to pay, we've contractually required to pay $152, we don't really owe it yet because they're contractually required to let us use this $5,000 for the 6 months. And if anything breaks that contract, then we wouldn't owe the added $152. What they have done at this point in time is we're going to say that they have loaned it to us for the first month. So 1 month has passed is what we're going to say here. So we're going to say we took out this loan in the end of January, the beginning of February, and 1 month has passed. So now we're going to say, yeah, well now we've accrued this 25 of the 152, and we owe that because we've actually used the money. So that's what we have to record. Now I can hear what you're saying probably is, well, you know, $25 isn't a big deal. Why does it matter? And it may not matter if it's a small amount like this, of course. But if we're talking about a large dollar amount, large loan, or multiple loans, then if it's significant or material, then it's something that we would want to break out and make sure that we're recognizing not just the principal portion of the loan, but the amount of interest that has accumulated what we actually owe on the loan at any given point in time. So that's what we'll do here. We're going to make this adjustment. We're going to go back to QuickBooks. We're not going to put it to the loan payable here, either current or long-term. We're going to accrue it in a new account that we're going to call accrued interest or interest payable, something like that. I tend to like to call it interest payable. Now there's a couple different ways we could do this. The traditional way would be with a journal entry. So we would go to the company up top and go to make journal entry. And the journal entry would normally be used for these adjusting journal entries. And what would happen is we would debit interest expense because we've incurred interest, although we haven't paid it, and credit the liability of accrued interest or interest payable. But for doing this, we'd have to know debits and credits. And I'm going to try to do this without the debits and credits with registers until we get to some more complex transactions. But we will get back to the debit and credit once we have recorded this. So to avoid the debit and credit and journal entries, I'm going to close this. We can go to the register, which we can find in at least two ways. One is going to the banking and going to the use register, and then finding the register that we would like. Now, in this case, we're gonna enter a register for a new account because remember the two accounts affected here. One's going to be interest expense, and the other is going to be a accrued interest or interest payable. Now, the register accounts here are typically balance sheet accounts. So we typically have balance sheet accounts. You see it goes down to equity because those are permanent accounts. So what we need to do then, we can't go to interest expense, in other words, and we don't have accrued interest or interest payable here yet because we haven't added it at this time. So what we're going to do then is use our other method to go to the register because we're going to have to go to the balance sheet portion, which is interest payable. We're going to close this back out. We're going to go to the lists up top and go to chart of accounts. And then we'll add another account. And we'll do that by going to the account drop up. It has a drop down like arrow, but it's really a drop up here. So we're going to go to new account. And it's going to be an other current. So we're going to select this item down here. It's going to be an other current liability, not an asset, other current liability account. We will select that and continue. And then we're going to say, so once again, other current liability in the drop down up here, we're just going to name this account. And again, you can call it accrued interest. I like to call it interest payable. So payable to means that it's going to be a current liability account more so than anything else. So I like to see payable personally. So then we have the subcategory, nothing there, no description, the account number. We're not going to have anything here. That's all we need. So we're going to say save and close. Save and close. Now we can go to the register by just double clicking on this item and it'll take us to a register. Now I'm going to change this date because I keep on not changing this 21 to 19. So all adjusting entries will be as of the end of the month, in this case the February, so 2/28/19, 2019. We're not going to put anything in the reference. We don't have any reference. You could, but it's not a check number or anything like that. And then we're going to put that this is the payable. Now, if we don't know debits and credits, or we don't need to, we know that the payable needs to go up because we owe more money. We owe the 25, it needs to increase. So we're going to say it's going to increase 25. And then we just need to pick the other account that's going to be affected, and that's going to be an expense. So we don't need to know if it's debit or credit. We just need to say the other side is interest expense. Why? Because we incurred it, just like if it was rent expense that we have not yet paid on the building. We incurred it, we used the money, we haven't paid it yet, we owe interest expense. Drop down, we can go down here and find interest expense. It typically is included if we have the default settings for the companies within QuickBooks. Just about any company, any industry we select, QuickBooks will give us an interest expense. So, or we can type it in here, interest expense. Now don't pick up the wrong one, as I have done in the past, because there's all these ones that start with I here. So we want the interest expense, not the interest income. And then I would typically put an ADJ, adjusting entry for accrued interest. And you may want to put the loan number or something like that. But it's really good to just at least label it as adjusting entry so we can see that when we go back and look at the detail and say, okay, those are things we did at the end of the month. Those are the adjusting entries. Funny things happen when we do the adjusting entries, or it could cause problems to the bookkeeper in the future, which we'll talk about later. But that is an adjusting entry. We're going to say okay. And it's clearly if this adjusting entry is done by like a CPA firm as opposed to the normal bookkeeping or some process outside of the normal bookkeeping, then we want to know that. Did we do that or did someone else do that? And why would they do that? So then it is a journal entry we can see here. And if we double click on that, then QuickBooks makes the debit and credit. So interest payable is being credited, which would increase it. Interest expense, debit. I'm going to copy this memo, right click and copy and put it down here as well. So we have the memo in both areas, and save and close. Keeping that change, going to close this back out, close this back out. Now we're going to be on our balance sheet, and we should see in current liabilities then there's the $25 for payable. We owe another $25 for the payable. That's in addition to the $5,000 that is included in the loan payable here. And if we double click on that, we could see that the loan payable is right there. So we got the $5,000 plus, closing this. The other $25 that is owed, go into our worksheet, which is the $525 principal and interest owed at the end of this point in time, according to our amortization table. All right, we're going to minimize this. The other side of this is going to be on the income statement or profit and loss. To find that, we're going to go to the reports drop down up top. We're going to go to company and financial, and we're looking for the profit and loss standard. Dates are going to be, let's say, 01/01/19 to 12 to, let's say, 02/28/19. And scrolling down to interest expense, we should then have the interest expense here. So there's the interest expense. Double clicking on that, we'll see the 25. Now note that this adjusting entry is a little bit more standard of what I would say is the norm for adjusting entries. Most of the time when we have an adjusting entry, we're dealing with timing differences. Going to close this back out. And therefore, there's usually going to be a balance sheet account and an income statement account. So note that the adjusting entries are not going to be like errors, problems that happened. They're going to be things that we plan to have happened at the end, and they usually deal with timing. They usually do not have cash involved in them. And they're usually going to have at least one balance sheet account and one income statement account, or one balance sheet and one profit and loss account. So when we broke out the short-term and long-term, we had two balance sheet accounts there. That's kind of the exception to the rule where we're breaking out the short-term and long-term. And also note that we might have some other things we do during the adjusting process, meaning we might find errors that we're going to go back and adjust. And those aren't really adjusting entries that are part of the plan. I wouldn't really call those adjusting entries. Those are entries that those are errors that we're fixing as we go through the adjusting entries. So it can be useful to keep those two things kind of different. The adjusting entries are usually, part of the plan, and usually have a balance sheet account and an income statement account, at least one involved of each. And then we could have other problems that we are fixing as we go through the adjusting entry problem, which aren't really adjusting entries, but are end of period error fixing. I would make a distinction between those two so that we can get a better idea of what the plan is and what is fixing an actual error within the data input process. Even if we do the data input perfect, in other words, we will have adjusting entries because it's part of the plan. For more accounting information and accounting courses, visit our website at accountinginstruction.info.